Alright, what's good guys? KYV. And this video is going to be a little different because I still do need to re-record Power of 3 video, and I believe it was like the key opens video. I do need to re-record those and upload those. And because those are the last two things before the time playlist is over. So I thought in the meantime, why don't I change it up a little bit with the server? We're going to do a bit of a different lecture and something I believe that I did need to talk about at some point, because this is literally the most important thing in trading. And you guys are going to tell probably by how long this video is, because this is going to be the longest video for sure. Just during recording it, I already know. But it's just going to be risk management. Risk management, honestly, you could be a gambler in these markets, and as long as you have a proper set rules for risk management, you'll be profitable, which just goes to show how important it is, because you could be taking one-to-one trades, flipping a coin, and maybe having a little bit of bias to it, and you'll probably be profitable just off of that. And knowing when to like cut losses, like how to maximize winners and minimize the losses, that's really what's gonna set you apart from 99% of the traders. So let's dive right into it. So we got a lot of topics to go over. We're gonna be talking about risk to reward, stop losses, take profits, sizing, de-risking, trailing your stop loss, taking partials, break evens, sitting out, and grading setups. So we got a lot to talk about today. Obviously, again, all super important. I literally can't say it enough. This is the most important thing in trading. So without further ado, let's dive right into it. First thing we're going to be talking about is risk to reward. So risk to reward is how much you risk versus how much you make in a trade. So let's say you're risking a $100 stop loss to make a $200 take profit. That would set your risk to reward at 2. And the reason this is important, because your minimum win rate will be determined by what risk to reward you go to and how much win rate you need to be profitable. So let me go on the charts and show you some examples of what I mean. All right, so I made this neat drawing right here, and this is just showing 4 different risk to reward projections. So the first one we have is 1-to-1 RR. This basically means whatever your stop loss is, your take profit also is. You're targeting the same exact thing in both ways. And for this, you need 50% win rate to be break even, because obviously if you win a trade then you lose a trade, you will be flat break even, because you wouldn't have made anything, you wouldn't have lost anything. 1-to-1s are actually very good, because the win rate is typically much higher, but that being said, you do need to have a higher win rate to go break even. So 1-to-1s are very good, they're very safe. I'd say they're super good if you're super close to a key level and you're just about to reach it and you want to trade up to it maybe, and you have a very clear target. So 1-to-1s are very good, but again, higher risk. I'd say slower profit, but I take 1-to-1 sometimes when that's what the market looks like it's going to do. Maybe I want to go for a lower move, or maybe have a bigger stop to work with. But yeah, this 1-to-1's 50% win rate to break even, and then anything higher than that, you'll be profitable. Next, we have 1-to-2. This is everyone's favorite risk to reward. And for this, you need to have a 33% win rate to go break even. So as you can see, you need to have a much lower win rate compared to 1-to-1. With that being said, you do have to get a bigger move. You have to catch 2 times what you would for 1-to-1. 2RR, I'd say, is like this sweet spot, because honestly, 1-to-1 sometimes it can be a little bit it's a little weird, because if you go on a big losing streak, maybe even a 3-day losing streak or 2-day losing streak, you're gonna wipe out a lot of progress. Rather, as if you go for a 2RR, you'll be fine from a 2 to 3 loss streak. So 2RR is very good. And then next we have 3RR, which you need 25% win rate to break even. And then 4RR, 20% to break even. And then anything higher than that, it just gets lower and lower. 5RR would be 16% win rate. But one thing I do want to say is that I know a lot of people have a set risk to reward in their model, and me personally, I do not follow a certain risk to reward system. So what I mean by that is, one day, if price action is looking like, hey, maybe I should take a 1-to-1 RR so I can have a bigger stop, because I think there's a lot of points where we could reject off of. Or maybe I'll take a 4 or 5 RR trade another day, because I got a very good entry with very minimal, very tight stop, and then a good target. So it really changes just depending on the day. I don't have a set target, and honestly, I think that's one of the best ways to trade, because in that way, you're not really forcing some type of high RR trade if that's what your model says, oh, take above 1-to-4 or a 1 to 5. But rather than that, you can say, okay, I don't see any setups for like a sniper entry to get a 1 to 5. So let me try to maybe go for a 1 to 2 today, because I do see this setup forming where I could enter here, have my stop here, and then take profit here, forming a 1 to 2 RR trade. And in my opinion, best way to trade. You know, I do it all the time. Like today um, I took like this, I think it was like 1.8 RR trade. And then sometime last week, I took like a 3 RR trade. And then there's times where I'll take like a 5 or 6 RR trade. It really just depends on what price action is telling me. But again, if you want a minimum RR or max RR to trade, nothing wrong with that. You can, yeah, but I like being open to multiple different risk to rewards. And I think that's a very good way to trade, honestly. But with that being said, let's move on to the next thing. All right, so up next, we have stop losses and take profits. So as you guys should know, stop loss and take profits are areas where you automatically exit a trade either off a win or a loss. So a stop loss would be a place where you automatically exit when price reaches a certain point where you think the trade gets invalidated. Therefore, you lose the trade. And then a take profit is where you want to exit the trade and take what you made from that trade. So placement should be determined by a target decided by you. So that could either be a risk to reward target, although I wouldn't recommend that. I would recommend always setting your stop loss and take profit on a drawn liquidity or key level, or somewhere around where you entered. And I'm going to show some examples of how to determine a stop loss and take profit so that you guys can know, okay, if I maybe want to enter off fair value gap one time or liquidity sweep, this is how I can set it. So let's just dive straight into it. All right, right here's a great example. So let's say I want to enter off of this fair value gap right here. In this example, we're just going to show like a fair value gap entry where stop loss would be. So let's say, okay, I want to enter off of here, long, here. So let's say, okay, I don't know where my target is. We'll say maybe this high right here. We want to trade up to that high over there. Though we're already pretty close to it, we'll just use that as an example. So again, right off the bat, we have this fair value gap. So this is what I like to do when I place my stop losses on fair value gaps or around a fair value gap entry. I either put it at a recent swing high or low. So right here is our most recent high or low. Sorry, not swing high or low, just a high or low. So right here, that's our most recent one. If I want to get a bit of a tighter stop, I'll do it at the bodies. And if I want an even tighter stop, I will go with a 5 point below the fair value gap stop. So right there, 5 or 10 points. So here, for example, I do like 20 point stop. And then maybe a little bit of a lower risk to reward target. So like we'll go with like 4, for example. And again, it all kind of just depends on the sizing of the gap as well, where you want to place your stop loss or take profit. Because with these smaller gaps, we could very easily wick through. And another tip about stop losses is that I would typically keep them preferably under 30 points. That is like a perfect entry for me. But again, it doesn't matter to have a bigger stop loss if the trade warrants it. So if it can be invalidated, for example, this trade, honestly, we have this gap right here. This could maybe be invalidated at this low if we cross this low. So we're just going to move it down there. And then that's going to be an 80 point stop. But again, if the trade idea can be invalidated in a bigger range, then it's okay to have a bigger stop. You don't need to have such tight stop losses all the time. And that's my number one rule, honestly. The amount of points that your stop is or your take profit is doesn't matter, as long as, again, we have a clear drawn liquidity and a clear entry. That's all that matters. So right here, again, we're going to see, okay, you get entered, you get filled there. And as you guys see, if you had a 20 point stop, would have gotten stopped. And then we have this gap right here. And then what do? We continue way higher. And then boom, we hit that full TP. So again, sometimes I know people can obsess with tight stops. I do it a lot too. And it's just a very bad habit because it just matters based on where the trade can get invalidated from. Remember, it's always fine to have a bigger stop loss. I'm going to go over stop loss placement with a liquidity sweep for one example, and then we'll move on. All right, so right here, literally, it was the previous day. This is actually a great example. So as you guys see right here, we have that liquidity sweep and we have a fair value gap. So somewhere where we could enter would be off this fair value gap, let's say. So let's say we want to go there, target this draw on liquidity. Your stop loss, again, since we got that liquidity sweep, would be at the bottom where the candle that swept that low was. So right here, this would be where you want to do, or where you want to have your stop. Again, even though we don't trade all the way back down, it is the safest stop to have. Like, by all means, you could have had a super tight stop, sure, and maybe it would have played out, whatever. But again, you have that risk of it just running straight through that stop in a second when it could still reach down here and still be a valid trade idea. And as you see, we do end up continuing way further up. And I'm not saying don't ever take super tight stop loss entries. I take like 20, 15 point stop loss trades a lot, actually. And that's because the setup is there and it's telling me, okay, this is a high probability setup. We should not go to my stop loss. And if we do, that means the trade idea and the concept was invalid. So just remember that. It all depends on the entry, drawn liquidity, and the narrative. It does not matter how tight or how huge your stop loss is. That's all that matters. So that's all that has to be said about take profits and stop loss. Take profit, remember, it's easy. Just have it at a key level or draw. Could literally even just be at a fair value gap maybe. But yeah, that's all about take profits and stop losses. We'll move on to the next concept, which happens to be contract sizing. This one is pretty important. So again, contracts, if you guys don't know, it is the futures contracts, and that just determines how much money we risk. And contract sizing is pretty important because you don't want to just blindly enter off of, a random amount of contracts. Because again, we're prop firm traders. Most of you guys watching, I guarantee 99.9% of you watching aren't trading on a live account or just maining prop firms. And you guys know we can blow our accounts. There's a max loss limit and everything, which is why contract sizing is very important. And with that being said, contract sizing, you want to follow a max risk rule and determine either a dollar amount to risk or a contract amount to risk per trade. Again, remember, the more contracts you add to a trade, the more risk you have. Now, me personally, I believe that sizing should be based off of max dollar risk and that you should base your contracts off of your max dollar risk rule. So for example, for a 50K funded account challenge, I'm comfortable with risking 0.5 to 1% of the entire account size. So that would be $250 to $500. So whenever I enter a trade, I will use the amount of contracts that will give me that $250 to $500 risk. I'm going to show one quick example of what I mean by that. So I'm going to go to the example that we just did about stop losses. So right there, let's say I wanted to enter off of this gap. So let's say hypothetically I'm on a 50K eval. I know a lot of you are probably trading 50Ks. And okay, I want to long risking 1%. That is a very common risk rule and something that a lot of people do. So right here, obviously, this is not $500 risk. So we're going to lower the contracts until we get that $500 risk. Right here, $520 risk. That is close enough. If you want, you can move your stop a little bit. And then bam, you have a $500 risk right there. So that is how you determine your contract sizing. Off of this, you'd enter off of 2 micros. And then that would be your risk for this trade. Again, that's why I don't blindly enter like a certain contract risk because, again, let's say you want to take this trade, but 5 contracts for this trade is a $1,200 trade versus if you maybe had taken a tighter entry, it could have been like $400. So it all just depends, I'd say, on the dollar amount that you want to risk per trade and base your contracts off of that. So let's move on to the next topic. Now we're going to introduce the most important part of this video. If you've made it this far, let me know and then start taking notes if you haven't already from here. Because we're going to be talking about de-risking. And this is so important because learning how to size down when needed can literally just change your trading forever. It can be done by removing contracts from a trade or trailing your stop loss, moving to break even, or sitting out as a whole. This will literally cut your losing trades by like 50%. No, not even joking. There's been times where I've been wrong about a trade idea, but simply because of the fact that I de-risked, I managed to literally profit off of a losing trade. So this is super important, and we're going to be going more into depth. This is just introducing what we're about to start talking about in this area of the video. But yeah, you can literally just prevent losses from happening and profit off of the losses. So it's super important, and in my opinion, it is literally the most important thing in trading. I de-risk every single trade basically, unless it's a very high risk to reward trade and there's very minimal drawdown. Then I'll obviously just let it run because again, I don't really care about a few points, like 15-point loss. But yeah, let's go and move on. So the first thing we're going to talk about is trailing your stop loss. What this is basically the more you go up or down in a trade and the closer it moves towards your take profit, your stop loss follows along. And you do this because you need to have a reason to moving your stop loss. So you can't just randomly move your stop loss because you say, oh, okay, we're already a little bit into like profit, so I'm just gonna move my stop because it's not gonna go down to my stop loss. No, you need to have a reason still. So let's say like we have a big move up and we form a bunch of fair value gaps. What you can decide is, okay, if this trade is going to continue to my take profit, and we formed all these fair value gaps, it should not disrespect these fair value gaps in this area. Therefore, I'm going to move my stop below those fair value gaps. And don't worry, I'm going to show you an example, but that is just an example of how you could trail your stop loss properly without just gambling. So let's show an actual chart example. We're only going to do one because there's so much to cover in this video, but I'm going to go in detail about it, so don't worry. So right here is an example that I would like to show. So right here we get a sweep of some recent sell side. We go on to the 1 minute, and we get this inversion fair value gap created. So right here, I would want to enter. This is a place that I would be interested to enter. Had a sweep of recent sell side liquidity, and then we also did have a higher time frame PD ray, I believe. We wicked through this 15-minute gap. So right here, automatically, okay, I want to enter. So I'm going to show you an example of how you could start trailing your stop. Again, we have this entry off this IFVG, but we'll just buy 5 cons here. 5 cons right there. Let's target that recent high. Sorry, not recent high. We'll target the high and have our stop right there. So again, just reminder of risk to reward. This would be a 3 RR trade with a 28-point stop. So that is ideal. So let's see. Again, we're going to play this forward. So right there, we get that retracement. And as you see, we get a pretty scary retracement. So if we continue higher and this creates a low, we could trail our stop to this low because there should be no reason that we continue back down to this low because this formed some low resistant liquidity, which is a protected area. Right there, we get that. We would trail our stop down here. As you see, we form a big string of fair value gaps. So again, what could we have done? We have this FVG right here, so we'll say, okay, if we maybe mitigate one of these FVGs, we can trail our stop even further. Okay, and we actually did that. So now we can trail our stop even more. We'll trail it to profit, and this is how you can literally, one of the many ways that you can profit off trades, even if it went back down and lost. And as you can see, we're already super close to our take profit. So what could we do? Well, if we're very close, something I do like to do is trail a bit more aggressive. Maybe not that aggressive. We'll stay down here. Down right there. Perfect trail. That was a very good example, and I'd actually like to use this trade for other concepts that we're going to talk about in this video. So I'm gonna keep this here, but yeah, as you can see, that is an example of how to trail your stop loss effectively and with a good reason. So let's move on to the next topic of the video. All right, so this one is honestly one of the most underrated ones. A lot of people like to hate on taking partials, but I believe it is very good when the situation is right. I typically, like 80% of my trades, I'm taking partials. And that's simply because if the trade is going to reverse, I want to take at least an amount of my win. And I typically do take partials for more contract heavy positions. And let's just dive into what partials are first before I go into depth. But partials are having multiple take profits during a trade where you remove the contracts as you go. So basically think of a trade as the money's not yours yet until you hit that take profit. Instead of that, it's like you're slowly just grabbing money out of the trade and pocketing it. So let's say, you have 3 take profits in a trade. Each take profit, you take a little bit of the trade into your own hand. So you take all the profit that you make, and then last take profit hits and you're fully out of the trade. And the reason that people do this is because if there's a certain point where, price could maybe be invalidated and you're thinking about moving break even, at least take some of that money and be able to secure a small win, even if it's small. Those small wins add up. And this is why I love using partials. Again, I like to use them for more contract heavy positions so that I still have some capital to work with on the trade. So people do this, again, yeah, like I said, just profiting off the move as you go rather than one huge TP. We're going to go back to the trade that we just showed because I saw a very good example of how we can take partials properly. So again, we're back here, but this time we're on the 5 minute. So I'm going to literally teach you how to take partials right now on TradingView. This is something I struggled with a lot. I didn't know for the first few months. And how to determine where do I take a partial. So again, we have all this low resistance liquidity right here. So a good area to maybe take a partial would be low resistance. But an area where I like to take partials the most is some sort of swing high or a PD array. And I'd say PD array is more important, especially this 5-minute gap right here is a perfect example. Let's say, we have this 5-minute gap. We have these equal highs as well. So these equal highs can be somewhere where we take partials. And another thing to note is that if we mark out this entire range, we are in discount. So let's say by chance this trade is invalidated. We can protect ourselves by taking profit at a point where that trade gets invalidated, but letting the trade still continue to our original take profit. So another place that we could take partials is these equal highs as well right here. And we'll do that for now. We'll have 3 take profits for this trade. So how would you actually use this in a trade? So right here, partial 1, partial 2, partial 3. Again, best place to take partials is at PD arrays or highs. Again, make sure you always look on the higher time frame because these highs are low resistance liquidity. So therefore, it's very unlikely that we're going to reverse, but it is more likely off of these higher time frame PD arrays. So again, PD arrays work best for partials. But again, we'll do the same entry as we did in the example before. So we'll do, let's say like 7 contracts this time. Again, stop right here, take profit up here. We're going to pair the two together. We're going to pair trailing our stop loss and then also taking partials. So right here, we'll let this run. We get filled. And then how to actually take partials. My bad, I didn't explain this. So what you're going to want to do is remove the drag TP. What you're actually going to do is determine how many contracts you want off each partial. So for example, this area right here, I'm going to take off 2. I'm going to take off 2 contracts. So we're going to sell, since we're in a buy, we're going to sell 2 right here. And basically, all you just got to remember is if you're in a long or short, let's say you're in a short, for example, wherever you want a partial, you're going to set a buy limit instead. And then contracts however much you want to take off. So since I'm in longs, I will sell 2, and that'll just remove 2 off of my trade. Now we have here, I'm going to take off maybe, take off another 2, and then we'll let the rest of the trade run. So right there, boom. And then remember, for your stop loss, you also do have to change it as it goes. I believe, actually you don't. You'll just get stopped and the rest of the contracts will be removed. But yeah, it's very important that you don't set your take profit because once the take profit hits, you'll be reversed in the opposite position because you have less contracts. So let's see how this ends up playing out. Of course, you know. Again, first partial hit. This is an area that we can move break even. Bam, right there. And then we're up 500. Take some more partials. Move our stop even more. Again, final take profit is right here. So we would sell the remaining of the contracts left. And 3 partials taken. Huge win secured. That was a $966 win. Of course, that one downside about partials is that, of course, we entered with 7 contracts. The full TP was 1,200, but we only made around 1,966. So you do lose a little bit of money, which is why I do like doing it on more contract-heavy positions. But it is just a safer way to play if you're in a bigger position. So that being said, let's move on to the next thing, which is just break-evening trades. So, break-evens. Break-evens is moving your stop loss to where you entered so that if it hits that area again, you are out of the trade without a loss or win. And you do this when a trade hits a certain point where it could be invalidated. So you want to move your stop loss to break even to avoid the trade turning into a loss. And again, it's great to pair with partials. Whenever you take that first partial, ideally you want to move to break even. And you can just sit back, relax. You don't even have to watch the trade anymore. You can just let that shit run. And then it'll either hit or you get stopped out in break even, or even if you trail to a positive stop loss, then you're going to profit either way. And in my mind, it's just the best way to trade. Like, you don't have to worry about watching the trade constantly. It's just risk free. And I'm going to show you how to properly move your stop losses to break even, because a big issue that I had, and I'm sure that a lot of people have, is that they'll move their stop loss to break even where it's not invalidated. So the trade will get break even, and then they'll just run straight to their take profit. And this still happens to me sometimes, which is why it's super important. I actually just had an example of this happening to me today. So I'm going to show that example because it's super important, once again, to be able to identify where is a good break even point. All right, so this is actually an example that I'd like to show. So right off the bat, check out this liquidity. This was actually a very good draw that I wanted to be taken out all day. There's these equal highs, and what do? We inverse this gap. So if you want to enter shorts off of this gap, right there, and then have your target at a draw on liquidity. So right here, right? We'll enter this trade, and we'll show you what actually did end up happening. So boom, we'll stop loss right there. Take profit right here. So let's see how this plays out. And let's identify some points where we could go break even. Number one, already looking at is some of these unfilled gaps. If we go on the 5 minute, there's no higher time frame fair value gaps. And that's actually something that's important to know, because if there's no higher time frame fair value gaps, these are just low resistance liquidity. These are all low resistance. Therefore, even though the 1 minute might look like, okay, oh, we have this low right here, or these fair value gaps right here, on the higher time frame, we don't have any PD arrays. Even on the 2 minute, I don't think we do. Okay, we have this 2 minute gap. We could say this 2 minute gap, okay, we'll go break even. Maybe to be more precise, this inversion. And this is forming live right now. Or just happened to form live. I don't think it's continuing. Yeah, it's not happening anymore. But that could be a point where you say, okay, I want to go break even. Again, just keep in mind, no 5 minute gaps. And on the higher time frame, this is all low resistance. So let's see what happens. Break even point got hit. So you would move your stop to break even, and just notice what happens. You get break even. So what actually ends up happening after you get break even is you just completely run down to the full take profit. And that ends up happening a lot. And that's why you need to be super careful where you determine break evens. Because right here we have this 2 minute gap where, yeah, price for sure could have rejected off of here and continued up, considering that we were in an uptrend before. But you have to look at the bigger narrative. On the 5 minute, this is all a bunch of low resistance liquidity. We had this high, these two highs, and no PD arrays within here either. Therefore, this break even was a bit iffy. It wasn't for sure. Maybe if we were to reverse off of here, I'd say a better target for break even maybe would have maybe been like this 5 minute inverse, because obviously higher time frame PD array, draw all the way down here, and let's actually see what would have happened. Maybe you take partials and break even here, see if we continue higher or lower. So okay, well, this hasn't formed yet, but I'll make sure to watch it and just keep that in mind. But that's why you want to be super careful where you break even. I'll show an example of an actual valid break even. Here's actually a pretty good example of a valid break even. So right here we sweep this liquidity. So these are all equal highs, and we have this clear draw down here, also this big manipulation candle. So we can anticipate, okay, you know what, we'll look for shorts, see what happens. We have this fair value gap that we could possibly inverse. So let's see. Okay, again, we formed that fair value gap. That would be our entry. So we would sell. Sell, set your stop loss and take profit. And then let's identify some points in price where we could break even. So let's go on the 5 minute and see what's happening. We have that 5 minute gap right there. We have multiple 5 minute gaps. No 15 minute gaps. So we'll play with the 5 minute gaps. If we were to truly continue lower, or sorry, higher, these gaps are relatively around equilibrium. So we'll say this gap right here, maybe this 5 minute gap, it's into discount. So that could be a good place to break even. So let's see what ends up happening. Right there, we tag into that 5 minute gap. Therefore, okay, we'll move our stop to break even, de-risk, because we should not go back all the way up here if we do truly want to hit our take profit. And then again, you could have partialed, maybe trailed your stop loss even more aggressive. For the sake of the example, we're just going to keep it at break even. So take profits right there. As you can see, we're very close. And we end up reversing fully, getting stopped out at break even, and continuing way higher. And why is that? Because again, the true intention was buys. We just reached deep into discount, into equilibrium, tagged into a 5 minute PD array, and then continued higher. So this would have been a completely valid break-even point and an example that is completely valid. We had those PD arrays. There wasn't just a bunch of low resistance lows. There were genuine places where we could have rejected off of. Unlike here, as you can see, for example, like this bullish move up for longs. We had a bunch of low resistance. We had this 5-minute gap. Again, that was a good place to break even, but it was all low resistance, and the trade ended up playing out. So let's move on to the last two things of this video, and then we'll wrap it up. The next thing is simply just sitting out. And this is the easiest one that can literally save you thousands of dollars, many payouts, and maybe solve all of your issues trading. And it is literally the simplest thing ever of just closing the charts and doing whatever else in the day that you want. And somehow people still struggle with it. And that's okay. Because again, it's easy to get excited about trading and, wanting to win, having confidence in yourself, and just knowing that you can do this. But again, sometimes that can be a bad thing, and not sitting out is a good example of that. And the reason being is because there's genuinely just times where we shouldn't trade. Whether that's choppy price action, or you just took a loss, or there's a high impact news day, and it could be super difficult. Just the urge of trading, thinking that, okay, you know what, like I'll just be extra careful today. And sure, you can be extra careful, but what's going to stop you from actually clicking that buy or sell button and then entering that trade on a bad day where it's low probability that your model doesn't play out? And that's one of the things that causes the most losses in trading. Honestly, not being able to sit out and identify when to just call it a day with trading and go do whatever else you want. That is one of the biggest things in risk management. So I'll say a way to identify when to sit out. Number one, obviously after you take a loss, no matter how big or small the loss was, I'd suggest you just sit out unless you know 100% you have a rule, maybe like, okay, if I take one loss, next trade I'll size down 50%. Unless you have a system like that and you know that you can actually follow it, and when I say no, I mean because you follow it all the time, then yeah, sure, maybe don't sit out after one loss. But for most people, I recommend after taking one loss, just close whatever device you're on that you're trading, and then go out and enjoy your day, do whatever, go back to sleep. If anybody's waking up early like me for market open, just go back to sleep. And that can make a huge difference, because when you lose, you're more likely to just start revenge trading and taking lower quality setups. And that can add up over time so much. That can blow countless evals and mess up so much progress that you've made all in one day. So sitting out after a loss is very important. And another thing is news days. I like to use myself as an example. Tomorrow and Wednesday, we have CPI, PPI, and Fed chair speaking on both days. I'm not going to be trading anytime from 8:30 to 10 at all, because honestly, the whole day probably. I'm probably just gonna trade Asia those days, because those days are so low probability, anything could happen. Obviously, if it was just CPI, yeah, it's fine, because that's even better actually for us, because market opens, we have news high and news low, but the Fed chair speaking, obviously that's going to take a long time, and it's just not ideal market conditions, so you don't want to be caught up in that. And the last thing is just choppy price action. This is honestly the easiest one, because I don't know how I'm going to look through chop and just say, oh yeah, I'm going to trade this. No, if there's no direction of price, just sit out. Sure, keep watching the charts, but don't trade until there's an actual direction or an actual setup that's formed. And that's all the advice I can give on how to sit out and prevent losses from happening by getting just caught in the wrong moment, trading at a time that you shouldn't be trading. This can save you so much money. It's genuinely the most important thing in this whole video probably. And yeah, let's move on to the last thing, and that's actually setup grading. So this is going to take a long ass time, so I'm not even going to show an example of it. But what I like to do personally is, depending on the setup and price action, this is a very good tip, I'd say. Depending on the setup and price action and the quality of just the day, the trade, and everything. For example, if it follows your model perfectly. So for me, for example, that would be like, okay, we get a perfect power of 3, like a perfect, within a perfect time frame, like a 1 hour, 30-minute candle. We manipulate into a higher time frame PD array and a draw on liquidity, and then we have a clean change in state of delivery and an inverse fair value gap and a fair value gap. If a trade like that formed, I am sizing up to my max size that's allowed. I'm doing the full, if I'm on 50K, full 500, obviously no more than that. Maybe can go a little higher depending on what your risk rules are, but I am sizing up as much as I can. And that's simply because the setup is there. Even if it loses, okay, I would have probably taken the trade anyways, but the setup was there and it was good. So obviously I'm going to size up because I've seen this a million times. I know it's going to probably play out. And an example of where you could size down depending on the setup is, for example, if we have a bit of a later entry. For example, if we had an entry much earlier, that would have given us like 3 RR, but we took like a 1.5 RR entry instead. You could be like, okay, I missed most of the move, so a lot of my break even points are closer. Therefore, I'm going to just size down on the trade and play it safe. And that's a very good idea. That's one of the easiest things that you can do to just make the losses a lot smaller. Just grade your setups. Look at how good the setup is every time you're about to take it and decide, okay, how much do I want to risk? Again, is it a very good trade? Is it A plus, or is it like a B plus B minus trade? And if it is, size down. And I'll actually just show an example for this. I'll try to find one best as I can. And then before we wrap the video up, I'm literally just going to show one trade where we use everything that we just talked about and showing, actually I'll do 2 trades, one loser trade and one winner trade to show how we can maximize profit and then also minimize the losses. All right, I mean, literally right here, this is like a perfect example of how I'd size up. So right here we have this accumulation, again, 10 a.m. Already know power of 3. We get our accumulation, silver bullet, fair value gap, all of these lows right here. I just want to see longs from here. And I'll set my conditions. Okay, if we manipulate downwards, I want to take longs wherever my target is and get a good entry. So let's see, again, already know what happens. We tag right in there. So then what can we start looking for our entry. So again, right here we have this IFVG. And then we do end up getting that. Bam, like it's literally perfect. So since that setup is super good and high probability for me, I would like to size up. So for example, I would go 10 contracts. Well, not 10 contracts normally, but I'd go with my max size, but we're just using 10 as an example. So off of here, we want to identify some break-even points. Honestly, along here, I don't see that many. Maybe we can just set a higher target, honestly. So here's what I'll do. We'll just do this. Fuck it, it's fine. So right there, have our trade. We'll identify a break-even point. Maybe that is going to just be as soon as we enter premium. That's what I like to do, honestly. We'll do it at this high right here. So again, we're just going to mark out break-even. Again, there's no parts where I really want to partial in this trade, so we're just going to let it run. You could partial off a bit here, which is what I'll do for just the sake of the video. So since we're going to break even there, we are just going to want to partial. It's honestly a good habit to do. If you're going to go break even, think about taking some partials, especially if you're in a contract heavy trade. So we're on 10 cons right here. So obviously we're going to want to go a bit, take some partials. So right here, boom. And let's see how this ends up playing out. This is a great setup for me. A plus. We're applying everything we use and talked about in this video. So once it hits here, we'll break even and continue trailing or stop. Right there, we hit our first partial. Therefore, I want to now move to break even. And since we got a huge displacement as well, I'll actually move my stop right there, below that low. Bam, right there. Perfect. We hit TP. If anything, you could have literally had a higher target as well. You could have targeted maybe like up here, and this could have been a second partial, and this still probably would have hit. The next example of a losing trade and how much we can minimize that loss. This is a perfect example of sizing up due to the quality of the setup, taking partials where it's valid, going break even where it's valid, and then also taking profit where it's valid. Just everything that we talked about. So let's move on to one example of a bad trade, and then we're just going to call it a video. And yeah, so this right here is actually a great example. So look, the setup is there. We have that accumulation, and obviously we have these draws on liquidity right there, and then also these highs on this side of the range. So we want to see manipulation into either. We'll check higher time frame PD raise. We have no higher time frame PD raise on the sell side. Let's check the 5 minute. No higher time frame PD raise. We just have that one low, but remember that is low resistance liquidity in the higher time frame. Now, meanwhile, on this side of the range, we do have some higher time frame PD raise. We have that 5 minute gap above those highs, and also a 15 minute gap above those highs. Right there, boom, perfect. So obviously, for this, I want to see manipulation down and trade higher at the top of this accumulation range. So let's see what ends up happening. Or we could manipulate up here and then continue lower. So let's see what IFVG formed. But the one downside about this trade is that there was no higher time frame PD grade that we manipulated into, and this looks very news driven. This is a news driven wick. So in order to avoid maybe a fake out to the upside right after news, I would maybe say, okay, I want to size down a little bit because I'm very like bit hesitant on this trade. It's not as A plus to me. And also we have this huge fair value gap. It could just go wrong many ways. So let's see how this ends up playing out. And we'll just set our entry as soon as that gap gets inversed. So right there, we'll have a buy limit. So right here, I would want to size down. And then somewhere where I could take partials, I'd say consequent encroachment of that gap is a very good place to take partials, I'd say. Have our stop right there. We'll take off 2 contracts maybe, or 2 or 1 contracts. We'll do 2. Sell 2 contracts right here and move to break even. So right at the consequent encroachment of that gap. So let's see how that ends up playing out. Final TP would be up here at these relative equal highs. Let's see. We get filled. Our first partial gets taken. Off of there, we would want to move to break even. So now this is a risk-free trade. Our TP is right here. And it looks like we're about to hit. And then what ends up happening? The trade fully reverses and we go the complete opposite way. Even though our target was literally how many points away? 475 points. But as you guys see, we still secured a win. We secured a win off of a trade that would have stopped us out. If you just left this trade, didn't touch it at all, and said, okay, I'm just going to take this trade and leave, you would have gotten stopped out. And what's even worse is that you were so close to your TP. You're going to get super emotional. You're going to get mad. You're going to be like, oh, it was so close to my TP. Why did this lose? I need to get back in and trade right now. And that's not good. Obviously, it's just going to happen. There's going to be times where this happens. But what we managed to do off what we learned in this video is still secure a win off of a trade that was supposed to lose. And just think about that. If you can do that for, let's say, like even half of your trades, you can use proper risk management. Let's say it only works half of the time. You're still saving half of the money that you would have lost on those losses, which is crazy. It's crazy to me how risk management is so important and how little is honestly talked about. I've never seen any in-depth videos like the one I'm making just going on about how important risk management is. But I just showed you right there, that trade, we would have been cooked. That we would have lost right there. But what did we do? We sized down when there wasn't any higher time frame PD array, and there was stuff that could have sent the trade the opposite way. And it didn't even hit our target, yet we still won. So that's just gonna wrap this video up. There's not much else to go about talking about risk management. Again, just a quick recap. We're gonna go back to the slide real quick. Just a super quick recap. We talked about risk to reward, how I use it just as sort of somebody's opinion, and then also the win rate that you need per risk to reward, stop losses and take profits, where to put them, sizing, how to size, depending on the trade, contract sizing, mask risk, de-risking on trades, which is basically just taking partials. But that introduced us to this whole segment where we taught you how to trail your stop loss, take partials, breaking even on trades, and sitting out when market conditions are not optimal. And then also finally, grading setups. And that's about it. That's really the secrets to risk management. It's honestly very easy. Again, you do have to really be careful for places where you like trail your stop loss or take partials at, because if it's not a valid place, then you could risk losing the trade entirely and missing all the profit that you could have made. And again, the losses are impossible to avoid. They're going to happen no matter how experienced you are. But this is what we can do to ensure that those losses are cut as much as possible and those winners are as big as possible, and we can make the most money possible out of each trade. So that's about it for this video, and I will see you guys in the next video. We're going to wrap up the time playlist after this, and then we're going to move on to some more advanced concepts, such as cracks and correlation and more. So I'll see you guys again. If you need a community, we have a free Discord in the bio. It's just a place where you can interact with other day traders. You can join in on these lectures live, ask me any questions that you have. And yeah, it's just a great place to learn and grow as a trader. So I will see you guys in the next one.